Welcome back to The Big Perspective, where we talk to some of the smartest minds in the Indian markets and pick their brains about the biggest trends shaping our stock markets. I'm your host, Bhavya Dua. In today's episode, we'll talk about the Indian bond market, inflation, and the Indian macroeconomic landscape. Well, the world has been a weird place ever since the pandemic ended. We saw advanced economies spend trillions to reduce the impact of the pandemic. And as a result of this, we had historic spikes in inflation across the world. And in response, we had global central banks increase interest rates at a pace not seen since the 1970s. Emerging markets like India haven't been immune to all these developments as well. Now, ultimately, all these big shifts in interest rates, inflation, etc. show up in the bond market, and what happens in the bond markets directly and indirectly affects how people borrow money. Now, there has been no shortage of the drama in the Indian bond market in the last 2 to 3 years. To make sense of these weird and fascinating events, I spoke to Sandeep Yadav and Suyash Choudhary, heads of fixed income investments at DSP Mutual Fund and Bandhan AMC respectively. In his 2 decades of experience, Suyash has managed large fixed income portfolios in places like Deutsche, HSBC and now Bandhan AMC. Suyash is probably one of the best fund managers in India, and his long track record speaks for itself. Sandeep has 18 years of experience in the financial industry. He's a seasoned fund manager with deep expertise across credit analysis, portfolio management, and strategic asset allocation. In this conversation, they share their views on India's inflation puzzle, structural changes in our bond market, the RBI's monetary policy stance, the global forces impacting our economy, the opportunities hiding in corporate bonds, and the big picture views that shape long-term investment strategies. Listen in to our conversation with these seasoned market experts on their big perspective.
I would say we are no more in a unipolar world that we saw probably 2010 to 2020.
Demand side inflation is not an issue in India.
It just signifies how mature monetary policy committee has become over the years.
You can pick what clothes to wear, what food to eat, but your biggest decisions will probably have only an element of your concurrence in them.
But discipline is probably the most important thing when it comes to an investor.
Getting into the details, I want to get your big picture view of the Indian economy before we deep dive into the bond markets.
Well, I think Indian economy is doing as good as it's ever done. We are seeing India's growth is quite robust, especially when you compare with other countries. We see most of the developed economies right now struggling. In fact, most of the developing economies are also struggling in the growth front. So India is doing quite robust. India has seen strong growth for the past few years.
When we talk about both the Indian economy as well as the bond market, everybody seems to be super bullish on India. But what are the risks that keep you up at night?
The reason to be bullish India from a bond standpoint, or rather more broadly from a financial asset standpoint, is the remarkable macroeconomic consolidation that India is seeing. So, for example, take how the current account deficit has compressed owing to a rise in services trade surplus for India. So India used to be a 2.5-3% of GDP current account deficit country. We are now a 1% odd current account deficit country. Government finances are rapidly consolidating, which is both a function of judicious expenditure management, but also importantly, rising tax to GDP ratio. So heightened tax buoyancy, courtesy a lot of reforms that have been taken over the last few years. And finally, RBI is a credible inflation targeter, and nobody doubts that RBI will deliver 4 to 5% inflation over the medium term. These are, the structural reasons to be bullish India in our view. The converse of that obviously is, for whatever reason, policy continuity assumption fails. Now again, let me emphasize there is no reason to think so. There was a brief period post-elections where some investors had started to question the same amount of commitment towards policy continuity. We, of course, were not in that camp. We thought it will continue. But the evidence now clearly, especially after the union budget, is that the government is very committed to continue the process of fiscal consolidation, to continue India on the path of macroeconomic stability, and RBI on its part remains a very conventional inflation targeting central banker, which gives a lot of comfort to global investors.
Also, this month was a volatile one with shocks outside India rippling throughout markets, right? So, what do you make of the global macro picture considering that the US and China seem to be slowing down and Japan seems to be the new epicenter for all new kinds of shocks at this moment?
Yes, so the last few years in some way have been one way. Basically, risk assets have done relatively well, barring small episodes of volatility here and there. There has almost been a global consensus that US will be on higher for longer interest rates, and Japan on average will be low interest rates, although Japan would normalize, but the normalization would happen without too much disruption. And that basically gave a lot of incentive for global financial investors to put on what are known as carry trades, wherein you borrow in the Japanese yen and then invest across the world. So a lot went into, let's say, tech sector equity stocks. Some would have gone into debt. Some would have gone into commodities, etc. Now, the evidence to the contrary for this trade has actually been building for some time, in a sense that US data has been slowing now for the last few months, thereby challenging the higher for longer narrative that people have ascribed to the Fed. On the other side, the Japanese central bank, at least lately, turned out to be slightly more hawkish. So not only did they raise rates, but they kept future rate hikes very much on the table. And this, apart from other financial market reasons, basically led to the first round of cleansing out of the so-called carry trade with sufficient amount of disruption, because it was such a large consensus trade for the last couple of years. So as we know, the Japanese yen had a volatile appreciation phase, and that disrupted a lot of asset and commodity markets across the world. Now, at least for the time being, that seems to be stabilizing. But the underlying point, the macroeconomic point remains quite valid, which, like you said, is that large parts of the world are slowing down. So, China, after a brief uptick in growth data, seems to be showing another round of weakness, which has also invited monetary policy easing, and Chinese bond yields have been falling one way. The US, like I mentioned, for the last few months has consistently been showing a weaker consumer, especially in the economically more susceptible parts of the population. Manufacturing is going through a terrible time. This is true not just for US, but also Germany, which is Europe's largest economy. So you'll find that large swaths of the world are now slowing down, and slowing down almost uniformly, at the same time. And obviously, that is leading to an escalation in rate cut expectations outside of Japan. So as we speak, markets expect the Fed to cut roughly 100 basis points this year and 100 basis another next year. So, while financial markets gyrations will continue, I think the underlying economic message is quite clear that the world is beginning to slow down. And one should expect more volatility than one has over the last few years. Also, maybe finally the time for bonds is back. And this is in a global context, not just in an Indian context.
I would say we are no more in a polar world that we saw probably 2010 to 2020, when US was, as the saying went, if US caught a cold, the rest of the world sneezed. And probably this is the time when we are talking about Japan catching cold or China catching cold, and India is still sneezing. Yeah, so it's no more a unipolar world. There are a lot of intricacies happening. Carry trade is something which we used to see in 2007-8, and suddenly after 15 years, carry trade is taking a center stage. China always had a kind of shadow on the global economy and Indian economy, but suddenly China is again taking a center stage, because when you see Chinese growth coming down, it's literally driving the commodity prices lower. It's driving global markets also lower. So it's a very volatile time. I can clearly see, I think the last time when we had this kind of issue was when we saw PIGS issue in 2011, 12, 13 in Europe, and probably before that was GFC. So these kind of interlinkages of global economies intertwined, and of course I'm not talking about COVID because that was quite exceptional times. So we have got so many global economies intertwined, and no more should we just look at US markets. But reading right now, it's volatile times. We have seen a lot of exuberance in the last 2-3 years post-COVID. When we came out of COVID, we've seen exuberance across markets, across economies, across the world. And of course, when things do so well for so long, you're going to find the speed bumps coming. We have seen those speed bumps, as you rightly said in the last couple of months. We have seen volatility. I think this volatility is only going to increase. This is not a We are going to see a lot of money which came into the assets in the last couple of years. We get a little bit nervous. And yes, be it equity, be it commodities, we are going to see sharp swings. Probably debt is the only place we have seen a lot of volatility in the last couple of years, but probably debt is the only place which will be less volatile than it has been in the recent past.
A few questions around inflation. Because our inflation data seems to be quite weird too, right? Headline inflation has been volatile. Food inflation has suddenly been sticky and rising. And core inflation is at its historic lows. So how are you assessing the inflation picture at this point?
I think that's a question to ask RBI how they're accessing, because we've seen, and as a market person, I think I have a liberty to say that RBI has been shifting the goalpost literally every monetary policy, right? There was a time when RBI said that headline inflation does not matter because core inflation is what matters to us. And then a year later, we heard RBI say that core inflation is not important, headline inflation is important. And as we speak right now, food inflation, which RBI has usually looked through because it's been very volatile, has taken a center stage. The way we look at it is probably inflation is not much of a worry, to be honest, even from RBI's perspective. But the fact is, RBI cannot be cutting the rates unless the global central banks, and especially US in this part, starts cutting the rate, because you don't want to cut the rates and suddenly you see US yields rising or you see global inflation rising and suddenly India's rupee becomes a little bit vulnerable. So from that perspective, while you do read in the headlines that inflation is a worry or food inflation is a worry or headline in quote, but I think the large part is that RBI is not comfortable in cutting the rates or sounding dovish. I think cutting the rates is still far away, but RBI is not comfortable sounding dovish in this scenario. And obviously, when you're not comfortable and you have taken a decision not to sound dovish, then you have to pick the data set which aligns to you. And that is what's happening right now. So inflation, again, is not a worry. But even if it was a worry or if it wasn't a worry, I didn't think RBI's decision is solely based on inflation, right?
So if I had to ask you the assessment of the trajectory of inflation going forward from this point, it will be going down, is how you concluded.
Like we discussed, the demand side inflation is not an issue in India because the fact remains that aggregate demand still needs to catch up a bit given the loss from the COVID years, right? And we are well on our way to do that. And like I said, we did not have any other option but to conduct policy like we did, because we didn't have the luxury of the developed markets, and the kind of growth trajectory we are witnessing is much more sustainable. So as an example, the US is now going to slow down quite dramatically after having grown above trend for a period of time, whereas India will remain in hopefully the 6.5% to 8% band for a very long period of time. But as things stand, demand side inflation is not really an issue. It's really just the volatile food items. And as this start to subside, this extreme dispersion that we are seeing in inflation, which is certain items rising at 10, 15, 20% and certain items rising at 3, 4%, that dispersion will start to close. And probably we'll head closer to the 4.5% that RBI wants over the next 6 to 12 months.
So moving on to the interest rates discussion, the RBI in the recent policy meeting decided to keep the rates unchanged. According to you, was the governor right in doing so?
Yes, they were absolutely right. Especially if you look at historically, RBI's decision in the last 12, 13 years when it comes to rate hikes or rate cuts have had more to do with currency rather than inflation. As I mentioned, inflation is very volatile. RBI does not put all its eggs in the same basket. Currently, we discussed how global economies are very volatile. We have seen how currencies are very volatile. We have seen dollar index being very volatile. And if you were to cut the rates and Fed was, let's say, not as dovish as RBI was, and then India's currency would just be very vulnerable. And historically, we have seen that currency plays a larger role in RBI's decision for changing the rates, even though it's not part of the formal RBI's mandate, but it plays a larger role. So absolutely, RBI was very right, in my opinion, for not cutting the rates, because you really don't want to go ahead on not even cutting the rates, let's say not even sounding dovish, because there were nowhere dovish, right? They were not even neutral. So I think RBI is absolutely right not sounding dovish, because currency remains primary important goal right now. When we have seen a lot of carry trade unwind, we have seen globally currencies whipsawing, dollar yen probably the best example. I think absolutely is bang right this time out.
So So, as you mentioned, most people attribute the sticky food inflation as the cause for high headline inflation. But high interest rates won't also solve problems like heat waves and poor monsoons. So, how does the RBI look at this particular dynamic?
There are various channels through which high food inflation feeds into generalized inflation. So, one channel is if food inflation remains volatile, and if the underlying aggregate demand environment is fine, then people will demand higher wages to compensate for the higher cost of their food consumption basket. If companies are able to provide those higher wages, they will in turn have to shore up their profitability by hiking product prices. And in that way, higher food prices leads to higher wages, leads to higher product prices, and then generalized inflation. So what started as just food inflation then becomes generalized inflation, and that is what RBI has to guard against. Their concern has been that inflation expectations of households have been rising for the last two surveys, reflecting probably the higher volatility in food prices. And basically, the expectation channel can very much feed into higher wage demand and then higher product prices, which leads to generalized inflation. And that is what RBI has been cautious about. The other point to note is interest rates in India are not exactly very high. So because like we discussed, the extent of stimulus in the COVID years was well thought out and administered in a calibrated way. And because RBI started to normalize policy fairly quickly and ahead of the curve, they haven't had to hike much in relation to what the long-term neutral policy rate should do. So all said and done, we are at 6.5% repo rate. I would be surprised if the long-term neutral repo rate in India is much below, let's say, 5.5 to 5.75, which means that unlike a Fed, where potentially the scope to cut rates is 250 basis points or thereabouts, and thus there is a good chance that you make a mistake if you wait too long, that risk really does not, is not relevant for India because at best you have a chance to cut, let's say, 75 to 100 basis points.
Also, over the last couple of meetings, both Professor Jayant Verma and Ashma Goyal have been dissenting and are calling for cuts. So how do you actually read these contrasting views on the Monetary Policy Committee?
So it's very refreshing, Bhavya. It's very refreshing because it just signifies how mature Monetary Policy Committee has become over the years. Gone are the days when MPC members would tout the formal RBI line and they would be unanimous decision. Just like in macroeconomics, we have dissenting forces, right? For each and every theoretical event, there's dissenting forces. Similarly, we see Monetary Policy Committee members having very different views on probably the same data point, which is the right way, and that is why you have got 6 members, because we want to go from the decision. So I'm very happy about it. And this also signifies that probably the data right now is not so one way that RBI can take a one-way decision of a rate cut or not having a rate cut. So this is a very healthy thing, and I really like it.
To discuss about the degree of rate cuts, I'll get a slight bit technical here. There was a recent RBI research paper which put the neutral rate of R start at 1.4 to 1.9%. Now, some commentators are using this to mean that the base rate has shifted higher, which means that even if RBI starts cutting rates, it will be a shallow rate cut cycle, right? But on the other hand, the RBI governor said that the talk of neutral rates, etc., are all just academic. So what does all this really mean currently?
This is not a debate which is only happening in India. It's happening in a lot of economies around the world, including in the US. And the debate basically goes that how is, if at all, the post-COVID world different? And has, the long-term neutral policy rate generally shifted up compared to pre-COVID. Now, so for example, in the US, a lot of researchers and private sector economists have opined that it is quite likely that the real neutral rate has moved up post-COVID. If I recall correctly, the New York Fed governor recently pushed against this idea to say that there is no real evidence that this may be the case, right? So it is something that is still evolving. Similarly, the paper that you refer to is by, one researcher or a set of researchers within RBI, not necessarily the view of the RBI. Having said that, it's our view as well that Most likely, RBI has room to cut 75 basis points in this cycle, not more than that, unless the Western world has a hard landing. Now, if the Western world has a hard landing, then of course RBI will have to cut rates to below neutral. But that is not the view currently. Importantly, despite only thinking about 75 basis points rate cuts, we are actually quite bullish on India bonds because we think it's a structural argument as well and not just a cyclical argument as far as India is concerned.
So the 10-year benchmark yield has also drifted steadily from well over 7.2 to 7.3% to about 6.8 to 6.9%, if I'm not wrong. So has the bond market already front-run the rate cuts?
Absolutely not. Absolutely not. And I think one of the main reasons I'll see that we have not front-run the rate cuts is because if you see the rate cuts in 2013, your 10-year bond yields came below the overnight rate. So right now, when your overnight fixings are happening closer to 6.30, they're not really happening at 6.5. They're happening closer to 6.30. You're still 50 basis points higher. If we were to front-run the rate cuts, then 10-year bond yields has to be much lower than where it is right now. So no. The reason why some of us may feel that, probably we are front-running the rate cuts is because there was a time when the Indian bond yields were at 7.30 and suddenly we see a 50 basis point rally and we say probably rate cuts are priced in. But no, I think when we were at 7.20, 7.30, India's overnight rate was close to 6.75, 50 basis point higher. So while RBI has not cut the rates, but still effective overnight rate has still come down close to 50 basis point lower because RBI has pushed in liquidity in the last one. So the current Indian 10-year yields have actually fallen down, and they've fallen down in line with the overnight rate. So I don't think they've priced in the rate cuts which haven't come so far.
So also talking about a bit around the regulations, I would like to ask about the budget as well. The government slightly reduced its borrowing. Now, what does that mean for the bond issues as well as for the bond yields?
That's a lovely question. India is very much more sensitive to supply, the fiscal deficit, than to monetary policy when it comes to 10-year bond yields and longer-term bond yields. And linking it with the previous question, when you asked, whether Indian bond yields have priced in the rate cut. On the contrary, Indian bond yields are pricing this reduced borrowing, which government announced in the budget. So we see India's bond yields have come down. That is getting priced in. But I think largely where our concern, and I'll use the word concern because as bond market participants, we want a genuine price discovery. But our genuine concern is that in India, the demand for Indian bonds is increasing by about 10 to 15% every year because the pension funds are increasing by that rate, insurance are increasing by that rate, the bank's balance sheet are increasing that way. So they all want to buy bonds. So every year they are going to be buying bonds 10 to 15% more than previous year. But India's government is reducing the GSEC expenses as they did this year. They are going in a fiscal prudence level. And I believe my concern is that it will be very difficult for Indian government or Reserve Bank of India to keep bond yields at a lucrative level for debt investors. So it will be interesting to see. So for me, I think right now is a very good. So earlier on, I said that this is probably the best time for Indians to buy the bonds. And this is one of the major reasons because the demand for Indian bonds is going to increase, keep on increasing. I just don't see how it can stop until India's growth stops. And India's influences are reducing. There's just not enough supply. So the way I see there's a genuine risk that Indian yields could fall closer to 6% if RBI and government don't find a way to increase the supply, which probably they will not be doing because the government is very clear that they want to go to a fiscal prudence. They want to reduce fiscal deficit. So that's why probably this is the best time to hold the bonds, whether or not RBI cuts the rate or not.
The RBI also recently issued a new draft rule on the liquidity coverage ratio, the LCR. Now, what does this mean for bond markets and yields?
So if it goes through the way it is, and even the RBI governor was at pains to point out that this is just a draft circular and they are going to incorporate market feedback. But if it were to go through, there are general estimates that it will require additional SLR buying by market participants, or more precisely, additional buying of high quality liquid assets, bulk of which will be government bonds by market participants. By various measures, the additional amount is pegged at between 3 and 4 lakh crores, which is obviously a very considerable amount should that happen. Our own guess is, eventually probably, some bit of market feedback may get incorporated. This is just a guess, this is just a viewpoint. And the eventual amount of, additional demand for bonds may actually turn out to be somewhat lower than this whole macro number. But nevertheless, we are headed in a direction where more high quality liquid assets are needed in bank balance sheets.
Given the rate cuts, one would guess that there would be some stress and defaults in the corporate bond segment, but that hasn't really happened. If anything, corporate balance sheets seem to be better than ever, right? So give me your big picture view of the corporate bond segment.
Well, we love corporate bonds. We love corporate bonds. And this is not India of 15 years back, 10 years back when we saw a lot of, probably I would use the word bad governance in corporates where the balance sheet numbers and were not what they would seem on paper. We have clearly seen India's governance improve significantly. The financial statements are much more believable right now. We don't, while there will always be crooks across the world, but I don't think it's prevalent in a large scale right now. So we really like the numbers. If you see the numbers of profits, we are seeing extremely good profits. We're seeing balance sheets are very safe. On the other hand, if we look at the NBFCs, we see while RBI is very, very quick to put to stamp or put a brake on any risky lending like we saw RBI do last year when it comes to unsecured lending or credit cards. So RBI has been very, very clear about not letting NBFCs and financial institutions go or. So we are very, very comfortable right now. Probably we are in a good time. Of course, the fact that we have got Aadhaar-based lending and the fact that we have got a lot of auditors being much more asking the right questions from the companies before auditing the results. We just feel that things have structurally changed in India, and we really like corporate bonds. And we are, as we speak, adding more risk into the corporate bonds as the government keeps planning
If one were to look at the opportunities there, AAA versus credit, what are the opportunities hiding there?
So some of those opportunities are indeed well and truly hidden and should not be revealed for some time. We think the order of preference has to be first government bonds, then AAA, and then credit. And I'll explain why. Apart from the cycle turning, which in the case of India is a relatively modest rate cut cycle of around 75 basis points, unless the West has a hard landing. The other reason why we are quite bullish India bonds is structural, which translates into the demand supply for bonds being very favorable over the next 4-5 years. However, the primary beneficiary of this is government bonds. Then the effect percolates to AAA and finally to lower rate. And why government bonds first? Let me just take a minute to highlight that. So in the post-COVID world, the government of India took the bulk of the fiscal expansion responsibility, because of which their fiscal deficit ballooned very sharply to, if I recall correctly, 9% of GDP or even higher than that. However, post-COVID now, it is the center that is consolidating its fiscal the most aggressively. By next financial year, they will take it down to 4.4% of GDP, which is a very aggressive consolidation over the last 3 to 4 years. Now, that means that the gross supply of government bonds in relation to other types of bonds in the bond market is rapidly coming on. So there was a point in time during COVID when state development loans to government bond supply was around 55%, which meant that for every 100 rupees of government bonds issued, only 55 rupees of state development loans were being issued. That ratio is now moving to 80 to 90. Which means that for 100 rupees of government bonds, 80 rupees of state development loans are being issued. So over the next 4-5 years, it is government bonds that are the most scarce asset from a supply standpoint. And then there is this bond index inclusion, wherein bulk of the demand comes for central government bonds and not SDLs or corporate bonds. So last viewpoint, over the next 5 odd years, the demand supply environment for government bonds is the most favorable. And that therefore has to be part of any long-term fixed income portfolio. Then, some bit of rub-off starts to percolate to AAA corporate bonds and finally to lower credit, because for most lower rated issuers, cost of funds is just one element of the business model. Many times those business models can absorb a higher cost of funds for a longer period of time as long as the balance sheet is relatively robust, which in most cases could be the case in the current circumstance. So, when the government bond curve starts to move down, we think spreads of all sorts will start to widen further. And therefore, like I said, first one has to build the highest quality book and then think about credit assets in round two.
But if I have to ask you, how are you positioned and the rationale behind that? So would you help me understand that? Let's start with the government bonds and then corporate bonds maybe.
Well, government bonds we are positioned as long as we can probably. We've got huge amount of 30-year, 40-year papers as well. And the rationale for this is quite clear. As I spoke earlier, the demand from pension funds and insurances is very high in India. It's increasing by 10-15% every year. The government is just not giving enough supply of those bonds because they're doing fiscal prudence. And the demand supply is very skewed in India. While, we might like talking about inflation and growth, but in a country like India where the debt is still an institutional play, the demand supply really rules the roost. And that's why we are in the long end, we are probably at an all-time low when it comes to the spread between the 30-year bond yield and a 5-year bond yield or even 10-year bond yield. But I think the spread will only narrow going forward. And it has worked very fine with us for the last 1 year. And we intend to continue with the position. On the corporate bond side, it just depends, right? At the end of the day, we really like some of the 2-year, 3-year papers. So in some of our active funds, we have got 2-year, 3-year papers of really good companies which are giving very good high yield. And why they're giving high yield? Well, largely because we see banks right now looking for deposits. They're really looking for deposits. They're willing to take deposits at a high yield just because there is no other way to get more deposits. And it's propagated across the shorter end of the yield curve, be it corporates or be it banks. So we really like to see the papers. We don't mind going to 10-year paper also at times. But right now, as we speak, I think we've got a little bit of a barbell where we like 3-year corporate bond, 4-year corporate bond quite a lot. And we like 30-year and 40-year G-Techs quite a lot.
Are some of these trades overcrowded? And also, how does the liquidity affect these trades?
Actually, not at all. So one hears a lot that long duration government bonds are overcrowded in India. And for the life of me, I cannot understand why people are saying that, because this is one sector of government bonds which is driven by pure genuine demand, which is the insurance and provident fund sectors. And they're buying it against actual concurrent or future liabilities. So these positions in their books are not speculative. They are being put there because they want to hedge payouts, which they are either incurring now or they will incur in the future. And for that reason, there is an active bond futures market or forward rate agreement market that is also cropped up, wherein many of these entities are locking away future liabilities by booking the asset upfront, which they will take delivery over a period of time. So, despite all the narrative that you hear for long bonds, actually most of the demand is need-based rather than speculative-based. On liquidity, one has to remember that the current bond market is very different from the bond market even 5 years back. So today, that 30-year and beyond, almost 35% of annual government bond issuances happens in the 30-year and beyond. This was, if I recall correctly, less than 20% 5 years back. So the 30-year, 40-year, 50-year is no longer an exotic part of the bond market as it used to be 5 years back. And, even though the day-to-day secondary market liquidity may be not as robust as the 10 and 14-year, because a lot of investors here are not speculative in nature. But, the ability to buy and sell is never compromised if you want to buy or sell. So long story short, neither do we think it's an overcrowded trade, nor do we think liquidity is an issue, because a very large portion of incremental issuances happens at the long end, and most of investors here are need-based rather than speculation-based. And finally, as real money investors, at this juncture, we want duration, right? So if there's a view that India is at the cusp of a structural move in bond markets, I would rather have more duration than less, wherever the mandate permits me to have. And that's also one of the reasons why, in fact, the number one reason, obviously, why we like long-end government bonds.
So you mentioned about the structural transformation in the Indian bond market, how it has changed, especially in the last 5 years. Now, with the growing involvement of insurance and pension funds, and now to a limited but growing extent of retail investors, even so, how does this actually change the behavior of bond prices? And if there is a permanent bid, does it suppress yields?
Well, bond prices are just going to go higher. And for us, it's a very, very high probability event that bond prices will keep on going higher. And exactly for the reasons that you mentioned. We are looking at pension funds, insurance. Now we are talking about even NPS, which is growing at 20+% YOY growth. And the size is humongous. The kind of banks that they have in the sizes are really large. You mentioned retail investors. Yes, retail investors are also there. And since RBI eased their entry into the debt markets, they're also there. But largely, it's driven by institutions, and they're buying at such significant pace. There's just not enough supply. And unlike equity, where companies can come up with FPOs when they see prices going higher, your promoters can sell their stake when they see prices go higher. In debt, it doesn't happen that way, because the only person who sells their stake or sells their debt is the government of India when we come to government securities. And in government securities, they're just not coming. Government, on the contrary, probably India is the only country where we see a lot of fiscal prudence coming along. Government is issuing lesser bonds. To put it in context, in US, we see so many negative news coming about government borrowing more. In India, the issuer, which is government of India, is just not issuing. So absolutely, I again reiterate what I just said 2-3 times earlier. For me, this is the best time Indian bonds has seen in the last 15-20 years. And we really don't see much of the risk of bond yields going higher or bond prices falling.
Also, how are you thinking about the inclusion of Indian bonds in the global bond indices?
So, like I said, this I think is now a story for the medium term. And we are not just thinking about this as one JP Morgan index, which gets us $25 billion or thereabouts. We think this is just the start of a medium term story where SBI participation, let's say, so SBI as a proportion of central government outstanding bonds is less than 3%. This can easily go to 6% in the next 2-3 years. Right? It can easily double, if not more. And, the JP Morgan index is just scratching the surface on this. So it's an important first impetus for global investors to then, now start to set up India accounts, to get familiar with dealing in India, trading in India. But I think the overarching theme there is the brilliant macroeconomic story that India presents and the scale of the India economy now. So bear in mind that, suppose we were the same macro story, but the 10th largest economy. Then the kind of interest would not be anywhere close to when you are this economy at the 5th largest economy.
Well, it is a done and dusted thing by now, let's face it, yes. But having said that, we are going to see around 20,000-30,000 crores of inflows coming for next 8 months. So while the news is done and dusted, the flows are not done and dusted. We have just seen 2 months of the flows happen, 8 more months coming. And they'll just keep on putting more pressure on the bond yields, because on the risk of repeating myself, I just repeat that we've got extra demand coming and we're just not seeing enough supply, which is government of India. They're just not supplying anything more. So the risk of yields rising is just not there enough.
But yeah, RBI also recently removed some tenors from the bonds eligible for foreign investors. Do you think the RBI is being overprotective here?
Well, I think they're thinking about the medium term, and maybe they just want to set the rules of the game upfront before too much money has flown into the system, and then change things.
Mm-hmm.
I'm not sure whether we fully agree with the reason for doing so. At the same time, one understands where they may be coming from. Also, at the same time, we don't think this will prevent global investors to coming into 14 and 30 years. So bear in mind also that a lot of the general government bond quota limits are also vacant right now. Second, the existing 14 and 30-year bonds are still FAR denominated. And third, we very well expect that a lot of off-index exposures will also get taken over a period of time as people get more comfortable with the Indian bond market. So even if over a period of time, let's say the index has very little weight to 14 and 30, We do think that off-index exposures will also be taken by global institutional investors who want to remain invested in India for the longer term.
Bigger picture note, some people argue that we live in an inflationary world at this point in time. That means everyone from the US to Europe is spending heavily on manufacturing. And then there's also the green transition, which is inherently inflationary. Then there are demographic changes as well, geopolitics, rising trade barriers, and much more, right? So is it wise to bet on rate cuts at this point in time?
No, that's a very good question you say, Bhavesh, because to be very honest, I also believe in that. I think from 1980 to 2020, what we saw was emergence of China. We saw Cold War going away. So a lot of commodity exchange was happening. A lot of manufacturing moved to cheaper countries. And we saw general disinflation across the world for nearly 4 decades. We are certainly seeing reversal of that. We are seeing a big commodity producer like Russia is now moving on one side of the globe. We are seeing China, which was and even right now, which has one of the most disinflationary impact of the world. We are seeing trade barriers coming. We are seeing Western countries not accepting their low cost imports. So yeah, absolutely right. The disinflationary process of the last 40 years is finding a little bit of headwinds. Having said that, there's some positive flows also. We are seeing AI, how it is lowering the cost on the other hand. But we don't know. I mean, it's too early right now to see whether AI can offset a large part of the trade barriers, as you mentioned, coming in the fore right now, or even climate change, because suddenly investing in new technologies is inflationary at the end of the day. So yes, that remains in our horizon, but let's face it. I mean, if it's going to pan out in 5-10 years, then most of us, if we're investing, we've got a 3-year horizon, 2-year horizon. I mean, I would really not want to look at 10-year long story and base my view on that. Especially when it comes to active funds, we are looking at 1 year, 2 year, 3-year horizon. In 10 years, we'll see probably 5 rate cuts, 5 rate hikes, and probably 5, 6 other events coming along. So it becomes a little bit too long a time horizon to view such things. We'd like to see things as they are and as we are. What really matters right now for us, especially for us in India, probably US investors, when they're investing in USDs, may have to worry about all these things. They may also have to worry about US fiscal deficit. But we must focus on what really impacts the market right now in the foreseeable future, and that is demand supply. And yes, most probably we'll see global inflation coming back in the next 10 years, but we don't know when. And I don't think anyone else can position our portfolio assuming such a faraway risk right now.
Again, going from talking about India to the global economy, the global rate cut cycle has also been quite weird. Japan is hiking, Bank of England and European Central Bank are cutting, while the Fed is expected to cut in September, but the RBI is still holding. That means there are some interest rate differentials opening up. How do you see this play out?
So one of the reasons this is so different is because the post-COVID policy responses were very different. And, we discussed that earlier in this conversation. So US went really overboard with fiscal aggression, which ended up overheating their system. And therefore, the Fed had to aggressively pivot to rapid interest rate hikes. India, like we discussed, was very well calibrated with its response. It took the medium term into account, and therefore RBI could get away with moderate interest rate hikes, and there was no real episode of financial instability, etc. in India. Japan has its, as we very well know, its own history, a long period of deflationary mindset, which only in this cycle has gotten corrected to some extent. And although the Bank of Japan is normalizing policy, my guess would be they will be more hesitant to do anything very aggressively because they can't afford to waste away this one shot of generating inflation sustainably that Japan has got in decades. So, a lot of systems have been in different places. I think some of the key themes which have been more general is many emerging markets have shown in this cycle that they can follow very traditional, orthodox, restrained macro policy, and they have been rewarded for that. On the other hand, we have seen developed markets or some of the developed markets being more adventurous with policy, which they had to then speedily correct through rapid monetary policy tightening. probably some of these differences now are beginning to settle down. So, in all probability, over the next couple of years, you will see most of the developed market outside of Japan cutting rates. You will see most emerging markets joining in, but to a modest degree. Some emerging markets have already been cutting for some time, so have some developed markets. And importantly, you will probably start to see bonds, kind of beginning to perform. So one of the frustration of global bond investors over the last couple of years has been, especially in a developed market context, that they have pretty much not been a hedge to anything at all. But that role is probably now turning for the better. And therefore, you would also probably find over the next 1-2 years a lot of interest coming back into global bonds.
Oh, I love it. I love it. And we've been saying it for the last couple of years that probably this is a time not to put your trades based on interest rate differentials. And if you remember a year back, there were a lot of stories that were coming along that the difference between US rates and Indian rates has come down so much. Indian yields have to rise up. It really is not going to work. We'll see a lot of those correlations break up. We have already seen them break up. And one of the best examples that I give to our investors when they're worried, especially in Indian context between India and US rates differential, is look at what happened in China. The Chinese 10-year yield is much, much lower than US 10-year yield. You look at what's happening in South Korea. South Korea 10-year yield is much lower than US 10-year yield. Now, I'm not saying that India is going to go that path, but India is a much changed country than what it was 20 years back. And to look at a 20-year-old chart and say that these are the rate differentials between these two countries and this is the way it should carry on, I think that is really not the right way. We have to look at the scenario right now. And it's probably right when we look at countries like UK, when we look at Europe, even RBA is also, if you see, they are not dovish. Or if we look at Japan. Even Japan is, it remains questionable right now. The thought process is that Japan is not the country it was 20 years back. Probably it's right, probably it's wrong. It's too early to judge on that. But certainly we do see, especially in Europe and UK, the kind of correlation that happened with US is actually breaking down. So we are going to see a lot of these correlations break down as a whole global structure breaks down. And probably emergence of Trump in 2016 was just advance what was always inevitable, and that is trade barriers coming along. And when trade barriers come along, even financial barriers come along. And when financial barriers come along, a lot of correlations which work out starts breaking up.
Are you guys worried about the entire drama about yen carry trade blowing up? Is that even a factor for the Indian bond markets?
When I started my career around 15, 16 years back, I was quite involved in the carry trade because at that time derivatives, not even 15, I think it's time flies by, right? It's nearly 18, 19 years. So at that time, carry trade really, really mattered. Carry trade was a big thing. I know carry trade is a big thing right now. So, but it's never so easy to figure out the data. How much of data is because of carry trade, how much of the flow is not because of carry trade. And I'm not talking from India perspective. It's a globally known thing. And I'm not such a big fan that the recent upheaval is purely because of carry trade. Of course, carry trades will have a part to do with it. But if such an upheaval was because of carry trade, I am surprised that none of the economists had raised this issue a month back, 2 months back, 3 months back. It was literally no one's radar as any of the risk factors. So no, if you ask me personally, I think there's too much of opaqueness and too much of haziness to pinpoint as carry trade as being the reason for the kind of volatility that we have seen so far. And because of this, I'm not sure whether carry trade is the right culprit to pinpoint if we are going to see any volatility or any impact in the global markets going forward. I think there's just too many uncertainties anyways and too many risks lurking around in global markets so far right now. That probably carry trade is just one of them.
We're also in a world of mega deficits, especially in the US. So although the US is supposed to have been going bankrupt over 30 years for now, it's still the 8,000 pound gorilla. And the world still revolves around the dollar, right? So is the risk of something going wrong with the US, and by that I mean a bond vigilante episode, is a probable risk?
So interestingly, Navya, that's one of the reasons why we think India is a structural story. And let me explain why. See, US, as you noted, is on a different fiscal trajectory. So pre-COVID, the federal government budget deficit was of the order of 4 to 5% of GDP. It is now in the vicinity of 7% of GDP. And the Congress Budget Office projects that over the next 10 years, it is likely to remain between 7 to 7.5% of GDP. Right? So it's a game changer the way US fiscal dynamics have descended. Correspondingly, the US is projected to continue to run a 3% on current account deficit. Right? Now, a combination of these two over a period of time probably means a continued depremiumization of US dollar assets. Now, what do I mean by depremiumization? It means that US remains the reserve currency of the world, but the premium you are willing to pay to hold US dollar assets is progressively declining. And the clearest way you can see that today is declining in differentials between well-run macroeconomies like India and US. And we think over the next 5 years, this continues. So I won't be surprised if in 5 years' time, India to US 10-year bond spread is only 200 basis points. Right? And the other way you will see this is possibly as the dollar peaks off in this cycle, which it may already have peaked out, you may see a secular decline in the US dollar over long periods of time, because one of the ways or one of the only ways you can manage this debt load that the US government is steadily accruing is to actually weaken the currency over time and probably accept higher inflation, right? Which is a slow devaluation. You can't even use that word, but it's a slow depreciation of the currency over a long period of time, which means that well-run macroeconomic stories like India's currencies versus US currency will not exhibit the same kind of depreciating pressure that has been the norm for the last 10, 15 years. And I think a lot of global institutional investors have already picked up on that. And therefore, most of this $12, $13 billion that has flown in as per the bond index infusion is all unhedged exposure, as we understand.
Also, before we really wind this up, another point when we talk about the global scenario right now is what are some of the biggest global risks that you are worried about that can potentially affect your investing thesis?
Look, so needless to say, geopolitics is one. The kind of geopolitical tensions that you're seeing is quite unprecedented. What is also unprecedented is the ability of financial markets to keep shrugging these off and continuing life as usual. But, this is always in the backdrop. Second is, a policy mistake of, let's say, a Japan central bank hiking too much. Or a US cutting too little, which is probably still more bond bullish than what we are figuring today. So one risk that I mentioned is bond bearish, which is a flare-up in geopolitics leading to a rapid escalation in commodity prices. India will have its buffers because remember, we are now a 1% current account deficit country. We are no longer 2.5%. So we can withstand short period shocks on commodity prices, but obviously bond sentiment will sour on the back of it for a short period of time. The other, which is going to be bond bullish, but asset market negative, is if, as growth slows, central banks don't cut enough, so that financial conditions actually tighten as central banks are cutting. See, the base case always has been that as growth slows, central banks will ease financial conditions and that will revive growth. In fact, if you see, previous cycles, the two templates you could have almost banked upon is that when growth shocks happen on growth slows, the Fed cuts rapidly, floods the system with quantitative easing, and China escalates fiscal stimulus. So on the one side, Fed provides you low cost of borrowing, and second, China, creates enough inflation in the world, and then the world basically revises from that, slowdown, etc. This time, both can be challenged. So the Fed has had a long period of inflation scare, and therefore probably the threshold to go to zero interest rates and quantitative easing is very high this time. And there's always a risk that although the first 200 basis point cuts will come quickly, the Fed may, hesitate to ease further. On the other hand, China's economic priorities seem to have shifted. They no longer want a debt-fueled, infrastructure-driven growth model. They want to now balance debt. They are more into the new age tech sectors, and they want growth to be sustainable. So it's unlikely that China comes up with a very large stimulus that helps the rest of the world also. So if you combine the two, probably the world has fewer backstops in case the global cycle turns as compared to previous global cycles.
Before we actually wrap this up, let's take a quick look at your career and what have some of the most pivotal moments that have shaped your approach to managing your large fixed income portfolios, and also how do these experiences influence your decision making today?
So clearly, there are two or three places that have been that have left a deep impression in my mind. Let me quickly take you through some of them. First is, I truly believe that, your biggest decisions are made by accident. You can pick what clothes to wear, what food to eat, but, your biggest decisions will probably have only an element of your concurrence in them. So I actually always wanted to be a consultant. I had a one afternoon free back in 2001 when I was between jobs, and Standard Chartered Mutual Fund had an opening. So I almost on a toss of a coin decided to go because I had nothing else to do that afternoon for that interview. And they ended up selecting me and I became a fund manager. I equally may not have gone to the interview and remained a consultant. Then, in 2008, at the peak of the global financial crisis, I was in HSBC Asset Management, and they were kind enough to make me fixed income head then. So I kind of took that responsibility on when virtually everything around me was collapsing, and that had a very large bearing on the way I looked at decision making, the amount of patience or lack of it that I had at that juncture. And then to kind of pivot myself or try to pivot myself to say that, look, the crisis is now over and you have to build a business or help build a business, which again then requires a different kind of thinking. So all of these have been places where we could have gone very differently. Who knows, for the better or worse, but I'm grateful for where I am. So yeah.
Managed diverse portfolios with significant assets under management. But how has your approach to risk management evolved, especially in volatile markets?
Well, Bhave, I think a couple of things which I always tell my team members or anyone I meet is that, and I've learned it with my experiences, one should never be married to their position. You might have a position, but just because you have a view does not mean that the markets will move based on your view, and you should be willing to exit your position. Even if you believe that nothing has changed, but if market is moving, at some time you have to take a stop loss. And I think the second thing which I genuinely believe is more than trying to make money, you have to understand that you have to live to fight another day. You cannot lose so much of your corpus that you can't really invest or take risks the next day. So it's very important. I mean, a lot of times people look at the returns or expected returns and they bias their position. But discipline is probably the most important thing when it comes to an investor. And when I say discipline, that means that you have to let go of your view at times and you have to just respect the markets. And that, for me, is probably the most important thing.
So you've shared with us your approach and the philosophy, but if I were to ask you, what were the key experiences that shaped this particular investment philosophy of yours over the years? So what would those special or particular experiences be?
Well, then that's getting personal. And when I was a young trader, I think a couple of years in the industry, and I was very strong of my view and I took huge positions, which I did not cut in time. And I'm quite lucky that I'm sitting in front of you because I was not fired that year. I didn't. And that was very important because I think it's very important to have bad times, especially early in your career, because then you understand the relevance of discipline and you understand the relevance of risk management. Why investment philosophy is important, but a risk management philosophy probably takes precedence. And that was a time when I was quite young and I made so many losses. And then I realized that trading and investing is not about making money, but about preserving money as well.
And well, that is all for this episode. I hope you're able to take away some insights from this interesting conversation that makes you feel a bit more smart. And well, stay tuned for such insightful big picture perspectives every week.